Hi everyone. So we're still in chapter 5, and this section we will talk about using credit cards and all the whole operation involving the credit card. Okay, so we will start by enumerating the advantages and disadvantages of using credit card. So we should know that a credit card is a convenient method for purchasing and paying for goods. Some we have some a lot of advantages. We will enumerate some of these one. Using credit card give us the possibility of paying for goods later. Okay, so we can pay for goods later, and we don't need to carry large amounts of cash, and it gives us the possibility of taking advantages of new sales, okay, of current sales, and it provides a monthly statement for purchases. Okay, so what we have as disadvantages of using a credit card, we should know that the financial institution issuing the card charges an annual fee. So we have an annual fee for holding this credit card in our pocket. Okay, so and if the balance owing at the end of each month is paid within, we have an interest-free period. Okay, if we pay all payments, or we pay all the balance owing at the end of each month within the interest-free period, so we have no further costs are involved, so no interest is charged. Okay, this interest-free period can be varies from 0 to 55 days. And so this is one of the advantages also of using credit card. But instead, we have, on the other hand, we have a disadvantage if the balance owing at the end of each month we don't have if the balance after the interest fee has finished. So if we pay the balance that we owe after the interest-free period has finished, so there is an initial charge equal to 1 month's interest on the balance outstanding. So we have an interest to charge. Okay, and in addition, an interest charge calculated daily. We have a daily calculation of interest from the end of interest-free period. Okay, we have an initial charge equal to 1 month's interest plus in addition we have a daily interest charge. Okay, so and a minimum payment. One of the disadvantage of using credit card is that we have a minimum payment must be made each month. Okay, so one of the advantage, we can obtain cash advances up to a certain limit, but in this case we have a lot of disadvantages, like interest is charged daily from the time the cash is withdrawn. Okay, and in this case we have a very high interest rate than purchases. Okay, so in the following page we have a credit card statement. And in this credit card statement, we have a lot of expression. We should know that we have here at top, we have a statement begins in 10 December 2012, statement ends on 11 January on 2013, and the account number of the holder of this credit card. Payment due date. So with the payment due date, 6 February 2013. Okay, so when the minimum amount that we talk about, that we have a minimum to minimum. So minimum payment must be made each month. So a minimum amount due is $37. We have an overdue opening balance. So we should to open the balance, we should pay for $225 per dollar. New charges, we mean here by new charges, all the balance that we owe during the month, all payments that we should pay during the statement, the credit card statement. Okay, the refund is referred to if we have an interest or not, or the closing balance that after the statement ends and all payments are subtracted from the opening balance, we obtain closing balance. Okay, we have also interest charged on purchases, annual one and daily rate of interest charged on purchases. We have annual purchase advance rate, and we have daily rate. We have the credit card limit as $3,000, and the available credit is equal to the credit limits minus the closing balance. Okay, so we will obtain the available credit. Okay, that so the limit that we have next to pay the next charges and purchases. Okay, so in the following exercise, what is the period the statement covers? So the period the statement cover normally is starting from 10 December 2012 until 11 January 2013. Approximately we have 30 to 32 days. Okay, so annual interest rate for purchases, annual interest rate for purchases is this one. We can find it in this location, 20% 24.24%. Okay, annual interest for cash advances. So for cash advances, we have this one. In this location, we have the annual one, 21.74%. Daily interest rate for purchases, we have here the daily purchase. So normally the daily rate we obtain it by dividing the annual interest rate for purchases. We divide it by 365. Okay, because the annum is equal to 365 days approximately. Okay, credit limit, we have the credit limit here in the bottom. We have $3,000 available credit. Available credit is here. We can see it clearly. Date by which payment must be made. So the date that payment due date is 6 February 2013. Minimum payment that must be made $37. So very easy to find this information using the credit card statement that we have on our hand. Okay. So the second question, calculate opening balance plus new charges minus payment refunds. So normally opening balance, we can see clearly the opening balance is $225. New charges, so new charges, we can find the new charges here, or we can also we can add this payment to this payment. Okay, Dr. Donald, for this payment. This one, auto payment, thank you, as it is equal to a refund or payments, okay, refund. And we add this one. When we add the first, the second, the third, and the fifth payments, we obtain the new charges. Okay, in 3 January we have auto payment as refund, the refund 225. So we will see why. So opening balance plus new charges, So the open balance is 225 plus new charges equal to 1,895 minus the refund. The refund is equal to 225. So normally we will obtain the same amount of the new charges. Why? Okay, we should note that in accounting, the closing balance refers to the amount of funds available to a business at the end of designated accounting period. Okay, we calculate by the difference between credit and debits. Okay, so the closing balance is the same the new charges because he paid the holder of the credit card paid the opening balance before the end of the month. How we know that? Because because the auto payment normally here the auto payment at 3 January. So normally the auto payment is the payment for, normally it is not a refund as we said before. It is the payment for the opening balance. It is done in 3 January before the month before the due date, when it is paid before the due date. So it's good for us. Okay, so for this one, then he charged no interest. Okay, and when this card had the 3-day interest-free period, explain why no interest has been charged. Why no interest has been charged? Because as we see here, all payments here, we can see here clearly that all payments 16 December, 21, 22, 3 January, 10 January, all these payments are done before the payment due date. The payment due date is 6 February 2013. So all payments are done within the interest-free period. Okay, so easy. And the next question, what percentage at the minimum repayment due of the closing balance? What percentage is the minimum repayment due of the closing balance? Normally, the minimum monthly repayment on a credit card is the lowest amount you have to pay to meet your credit agreement. Okay, so normally the minimum repayment is equal, the percent of minimum repayment is equal to the minimum amount due over the closing balance, by we times 100. So the minimum amount that due is equal to 37. 37 divided by 1,900 normally 895.35. So we multiplied by 100, we obtain 1.95%. Okay, on the, if only the minimum amount due is paid, if only the amount is due is paid, on what amount will interest be charged? Normally, on the next statement, the interest will be charged on the amount closing balance minus the minimum amount due. Okay, so normally it is equal to the closing balance 1,895 minus 37. We obtain this amount that on the next statement the interest will be charged on. Okay, so thank you for listening. We explained all about how to use the information on any credit card statement. And thank you for listening, and I'm waiting for any other question, and bye bye.